Okay, let's get to some questions from Sunday's market outlook. If you had to put a percentage on it, what's the likelihood of a significant recession occurring in the U.S. economy in 2023? So there's a couple of things here. Are you asking for the likelihood of a significant recession or just any recession? And it must be 2023, right? Well, the conditions are right. So if an exogenous event showed up that was significant enough, something geopolitical or something credit related, that would cause it because the conditions are there for it. We are in the second quarter of earnings. When I say second quarter, the last quarter of last year was the first quarter of negative earnings growth. So we're in an earnings recession. If this quarter comes in the same way, there's the earnings recession, which usually precedes the actual recession. It is what causes companies to cut costs and lay people off. And when they lay people off, well, aggregate incomes go down. When they cut costs, well, those costs were somebody else's revenues or income. Same effect, which then lowers aggregate demand, which then causes another round of layoffs, which lowers aggregate demand, which, you get what I'm saying, continues on. I'd say endogenously led 2023, probably 50-50 at this point. Any exogenous event, given that the conditions are right, I'd say it's 100% if, that's a conditional now, if an exogenous event shows up, especially one credit related, you can put that at 100%. If you're not using the classic trader workstation layout and you're using mosaic view, you can get bonds under top left, new window scanners, bond scanners. So I've tried mosaic. I just don't like it. It just seems that I can get things done in classic, and I'm in mosaic and I go, okay, well, where is this now? And I've got to spend all this time trying to find things, and I think maybe it's got more power, I don't know, but just the drop in productivity, trying to figure out where everything is anymore. So I always just keep it in classic view. Let's see, is there a more detailed breakdown analysis of ABR or agency on your applied series? Yes, there is. Much more detailed view on agency and, yes, in ABR. In fact, on this channel, if you search for ABR on this channel, you'll find a couple of videos already. Your opinion on how could incoming retirees utilize their capital better to fund their retirement? I understand it's a loaded question. Just thought I'd ask, provide some insight. Well, fixed income has yield, finally, right? So you can go into investment grade, maybe consider some of the debt of the banks, some of the Canadian banks at least, some of the debt of the utilities. If you're in the U.S., utilities are probably a great place to be. The preferred shares are the debt of utilities. Or just straight old government debt. You are getting a yield at this point. Heads up that tax day this year was April 18th because Monday was a holiday in DC, just in case you need to refer to that in the future graphs or calculations of what you have. So that would explain why the 1 month dropped later in the week because by the time we found out what the receipts were, the market found out what the tax haul was, well, it didn't help things. Wondering for the applied series, will you do an analysis on a mining company? Yes, I will. In the applied bottom-up analysis. Yep. So here's a timeline. Here's where we are. Here is May 16th. This is the release of level 1 and level 3 for 2024, and this is what I'm working on right now. And then level 2 is sometime in August. So I've got some level 2 updating to do here. And I usually work on the applied series from August to about February of the next year. And then I'm back in CFA mode, then back in applied series mode, then CFA mode. You get what I'm saying. So new content is added rather aggressively over 6 months. And then almost nothing for 6 months while I get CFA ready. But yes, Freeport is probably the one I'll pick. Currently planning study for, okay, that's level 1. Some analysts are pointing that inflation pressures might push the Bank of Japan to finally initiate a tightening cycle in the second half of the year, and that their first step should be removing their yield curve control policy. They have said as much that later in the year, yield curve control is on the table to be eliminated. If that would happen, we should see some degree of Japanese investor savers moving capital from U.S. Treasuries into JGBs. Most Japanese are holding JGBs to begin with. It's the central bank in Japan that's holding U.S. Treasuries, but they're not really holding it for an investment purpose. So I don't know that it would cause much to happen there. What it would cause initially is the yen to strengthen. So you would have to think of, well, what are the carry trades? Those would unwind very quickly because that's a major threat to a carry trade is if the financing currency starts to strengthen. I don't know that there'd be, I don't know what the effect on the treasury market would be. But coming from Japanese citizens, I think insignificant, considering that they are the largest foreign holders of U.S. Treasuries. That's the central bank. It's just the central bank, and I don't see that the central bank would reduce its U.S. dollar reserves. When a bank has foreign currency reserves, it doesn't just sit in cash on a shelf in a vault. It sits in securities that earn a yield. Let's see. If we assume record low listing holdings for residential home prices, listings holding residential home prices high, I had to figure out where the break was there. What would be more supportive for home builders? What would that be more supportive for home builders' equities or for REIT equities? Well, home builders. What are the key factors driving performance of home builders versus REITs? Well, I imagine you must mean apartment REITs or residential REITs. I don't think you're mixing home builders with office REITs in there. I mean, you must mean residential. Well, normally it's GDP growth, which is the key driver. But when you have an inventory shortage, you don't need many drivers. And that's the issue right now. What would you reckon has been the most important booster of residential home prices in the last few? It's all just supply. This whole space right now is a supply issue. There simply just isn't enough supply. So you can ask the question three different ways. The answer to the three questions all comes down to there's minimal supply. Wondering if you knew the specific details of how government CDSs are paid out. Not really. I thought about that. I didn't even, until I read it, I didn't even know that there was a market for CDS on U.S. government debt. Apparently there is. So you got me on that one. When I had first read it, I thought, really? CDS on U.S. government debt? All right, I guess. So I don't know how it works. With the CDS, it will respond if you buy a CDS and the credit spread widens, the CDS gains value. So you don't actually have to hold the CDS until there is a credit event. The CDS will change in value as the credit spread changes. It's just a way to bet on the credit spread changing as well. You're going to pay a premium to make that bet, but you can close it out without having a credit event. With your TLT strategy and recession thesis, why not use EDV? Well, you'd have to look at the options, and if the options are not liquid or they have big spreads between the bid and the ask, it sort of just takes that out of the way, right? If you could provide some commentary on utilizing floating rate CLO ETFs versus money market future fund, it's not my scene. I know nothing about that stuff, so I'll leave that. More general question on how you apply sector rotation. Are you factoring sector positioning as you start to build your positions in the miners and home builders? Are you factoring in sector positioning? Well, I mean, yeah, right? There's miners and there's home builders. I guess I'm not following the question because it just seems like it's an obvious answer. Wouldn't it be more ideal to wait until we have entered a recession or seen the economy bottoming out? I got the same issue late last summer when I started talking about the home builders. This is when D.R. Horton was, under 80? It's almost 110. The home builders have just delivered and delivered and delivered all throughout. So no, I don't think it's worth waiting because, stuff like that happens. No, I don't know that it's more ideal to wait until we've entered a recession. Let's see. Can you explain a little about the futures roll yield? I was trying to add some duration by using futures, but all the products have positive roll yield as they would. Financial futures have positive roll. Well, I shouldn't say positive roll. They have negative roll. I think what you're trying to say is that the futures price is above the spot price, and you're considering that positive roll. It's only positive roll if you're short. Then you have positive roll. If you're long, it's negative, and that works against you because most financial futures, when interest rates are this high, have a contango slope to the term structure. Is there any method to calculate the roll yield to make sure it's reasonable? The cheapest to deliver is on, you can find the cheapest to deliver underlying each of the contracts on CME and the conversion factor. So you can multiply the cheapest to deliver, the price of the cheapest to deliver, by the conversion factor. And that would be, well, that's a futures price as well. You'd have to look at the actual price of the cheapest to deliver. Yeah, it's a little bit more complex, but CME should provide it for you. Is there any method to calculate the roll yield to make sure, to make sure it's reasonable? What's reasonable, right? It's going to be, if you're long a futures contract, you got negative roll. So when you say, is it reasonable, I can tell you that the higher the short-term interest rate, because the futures will be priced with the short-term interest rate, the higher the short-term interest rate, meaning the 3-month, the 6-month, the higher or the more negative the roll yield will be, because it's calculated on the full value of the underlying. So I don't know if you're going to find it to be reasonable. They'll all be proportional with each other because they'll all be a function of time. ZQ has negative. ZQ has no roll yield. ZQ is just an index. So if you're buying December, there's no underlying to be delivered at all. Because there is no underlying, ZQ is really just an index price. It is 100 minus R being the effective federal funds rate. So there is no roll at all in ZQ. It seems to me that just buy ZQ. Well, if you're buying ZQ, you're betting on the index going up, which means you're betting on interest rates going down, and keep rolling, have a lower cost and generate a better return. Well, it doesn't work that way because with ZQ, there is no roll. You get no negative roll or positive roll, so no, you wouldn't get a better price by rolling it. Your price would always be the same. So if you bought ZQ at 95.5 and it expires at 95.2 and you roll it to the next month, it'd be 95, whatever the next month happens to be. Let's say it's 95.25. You're still going to realize this loss, and there's your new price. It's because there's no pickup in rolling forward because it has no roll yield. If I want to create a synthetic bond to add another 5% yield to my portfolio, let's say 200K, which one is it better? Well, why not just buy a bond? Why not just buy a 6-month that's yielding 5%? Why create a synthetic bond? Why not just do a bond, right? But 5%, a synthetic bond. Well, you can create a synthetic bond with a combination of stock and options. But that seems like a lot of work to do when you could just buy a bond. It's going to require the same amount of capital. Just buy a bond. One question regarding government bonds on emerging markets. If you were to highlight the top 3 macroeconomic factors driving EMB, which ones would you pick? There'd be only one: global growth. That's it, just global growth. For the SPY screen, could you please summarize which data you use and why so? I think I only use the chart. I have gone through the rates tutorial. Well, rates, yeah, there's a lot to understand in rates, but the chart that I show is just the price of the index wrapped up in the ETF, which is SPY, because it's accessible to most people, but it's just a 1-year price chart of the index. I don't use anything special there. I use the forward earnings estimate from S&P Global, and from that you take the price of the index divided by the earnings and you get a multiple, and that's it. There's nothing. There's nothing that I use there. I don't know that it would require a video. As a retail investor, what do you think is the advantage or disadvantage compared to initiation and hedge fund? Let me read that again. As a retail investor, what do you think is advantage and disadvantage compared to initiation and hedge fund? Do you mean institution, pension and endorsement fund, and hedge fund? What's the advantage and disadvantage? For what, though? For what? Chances are I don't know what an endorsement fund is, unless it's in your particular country. Endorsement fund means something that has a common word in that I'm familiar with, but I'm not familiar with the word endorsement fund. I don't know if you mean initiation or, okay, so I'm going to pass on that first one. My guess is large fund has better information process and can access different or better products compared to smaller player. I don't know that $100 million fund can't access the same investments that $1 billion fund can. I think that $1 billion fund leaves bigger footprints, and a $100 million fund could probably move faster and take advantage of more opportunities that the bigger fund couldn't. No, I'm not clear enough on the question to know how to answer that. I'm wondering, what is your way of tracking your trades in terms of CME, IPS, SAA, target time frame, etc.? I'm not formal. I don't sit down and write out a whole document and then stick to my rules and have an oversight committee and that kind of thing. Capital market expectations, you see me do them every week. IPS, not really. SAA is more experience and intuition that tells me where I want to be. Target time frame, it depends. There's no answer for this. Like it's not as if I'm a fund that can provide you with documentation and says, here's our investment process, here's the investment thesis, here's our target allocations, here's our rebalancing ranges and our target ranges. We're tactical here, we're strategic there. It's not like that at all. It's when you first start, you should have very tight rules. Much like when you're learning, for example, to play piano, you really have to learn the notes. You must play piano, basically almost like a science. And then you get to a certain point where you can get rid of the notes, and then you can improvise and you can create from there, and you can move in and out of the notes that are on the page. But if you learn the wrong way, it's hard to fix later on. So you spend a lot of time on structure and style. It's the same with investing. Is you spend a lot of time in your earlier years within a defined structure. But then after a while, a structure I'm not going to say it handcuffs you. It just limits what you can do. So when you hear that, a lot of managers fail to beat their benchmark, I believe that. So if you say, well, here's your benchmark doesn't have options, you can't use options. Your benchmark doesn't have currencies, you can't include currencies, you can't include bonds. Your benchmark is the S&P 500. You can't have short positions, you can't have derivatives, you can only buy and be long. So all you can do is overweight certain sectors or certain stocks and underweight others. Yeah, that's hard to beat. It's hard to beat the benchmark when that's all you can do. Right? And if you find some way of doing something, and there's always the question of, well, could we automate that to create a passive vehicle that does the same thing you're doing? And if that's true, well, then that passive vehicle now becomes your benchmark. So that you have to have some kind of alpha that cannot be automated to be a passive investment, that you can't imitate what you're doing passively. So yeah, it's brutally difficult to beat a benchmark. But if you uncuff me, if you say you can invest in anything you want, anywhere you want, your benchmark is a cash rate plus 500 basis points, let's say. So the cash rate is maybe a 6-month rate is 5% plus, add 500 basis points. Your benchmark is now 10%. It's an absolute benchmark. That makes more sense. Can you beat an absolute benchmark under every single market condition? And when you can do that, imagine trying to write an IPS and a strategic asset allocation for somebody with an absolute benchmark that can do anything they want, whenever they want, as the opportunity arises. Without being constrained by, well, your weightings must be within this much of the benchmark. You can't step outside of this. You can't use this, can't use that, can't short, can't use leverage. It's almost impossible to write out an IPS and a strategic asset allocation for a strategy that is that organic. So it's what you read in the textbooks is really a process for institutional investment. Now, if I were going to attract money under management, then I'm going to have something to provide, some investment philosophy, some process by which I make my decisions. It can't just be anything off the top of my head, but I don't do that. In terms of currency trade, what is your reporting currency? Canadian. I'm relatively new to your channel. On one of the older weekly reviews, you mentioned something about bulls using the increase in money market funds as a reason as to why the market can keep going. You mentioned the counter to that with the fact that those funds came from deposits, that they probably go back to being deposit money funds, bring down the rates in the future. But wasn't deposits at extremely elevated levels prior to the rate hikes in 2022? Well, let's say that you give somebody who's never invested in the markets $100,000. They're probably not suddenly going to start investing in the markets, right? It's not going to find its way into the market. That the money on the sidelines somehow belongs to the equity market is a fallacy. There's always money on the sidelines, always. With institutional making up a big part of it, because on balance sheets everywhere you have cash and cash equivalents. Well, those are the cash equivalents. That's cash. That's not money on the sidelines waiting to go into equities. That is truly money. That's where it lives. That's its home. It's not the sidelines. That's its home. Is there money on the sidelines at times? No, I think there is, but all the money on the sidelines is not money on the sidelines. That's the point. Is if you're moving out of equities and you're moving into cash, and at some point you're going to move out of cash into equities, I'm sure that does happen. But it's not as if in a raging bull market there's zero money in cash equivalents. There isn't. There's lots. There's always lots. No matter, you don't even have to look. If you're bullish and somebody says why, the very first thing out of your mouth should be, there's a lot of money on the sidelines. Why? Because it's true. If you think that money market funds are the sidelines, you can call it the sidelines. But it lives there. That's the point, right? It's never going to get into the game. The towel boy in a football game hangs out on the sidelines. But you wouldn't say, how can your team continue to play? You have a wounded player. Oh, we have more people on the sidelines. They're not players. That's where they work, on the sidelines. Let's see. Can you go into a bit more detail about the tax implementation date on June 15th? That's when you have, for example, I am self-employed. So when I pay tax, my tax installments are set for the year. So I pay in installments for the very year I'm in before I even file for those taxes. And that's there are certain tax installment dates. They'd be different in Canada than they are in the US. For corporations, it's monthly, if your corporate tax is high enough. For individuals, it's quarterly, at least in Canada. So in the US, companies have to pay, so if they paid $10 million in tax last year, every quarter they must submit $2.5 million against their current income, as opposed to waiting till the end of the year and paying just once. That's what the June 15th is. What is functionally happening on that date? The Treasury gets a whole pile of money. What is the scenario if Republicans and Democrats don't close daylight? Well, then that's it. You got to start closing things down. You got to close down parks. You got to close down, you close down as much as you can so that you don't have to pay out as much. You try to stretch the bank account for as long as you can. And when you're out of money, that's the end of it. You wait until the clowns decide to all get into the same car, right? What is the nightmare scenario that is pushing up the CDS, and what steps can one take to prepare for it? I don't know that there's anything to prepare for other than just a clown show. And maybe, to make a point, you might have a government shutdown for a couple of weeks to continue on the clown show. This is just a clown show. In the end, somebody's going to, they're going to figure it out. When they start seeing things fall apart, they'll figure it out. But until then, it's going to be a clown show. That's what clowns do, right? They want their show. What are the extraordinary measures the Treasury can do that and have they done them in the past? Yeah, they have done them in the past. You start cutting as much as you possibly can. One more question on selling ES puts. While watching for ES pullbacks and volume on 0 days to expiration, are you selecting your strike based solely on volume on the put? No, I just like 4170. It could easily be 4160 or 4150, but when I calculate all the calls and all the puts I have, 4170 seems like the nicest number to use. It has the right delta that I need. It just, it just kind of, I could have done the 4150s and did more of them, or the 4180s and do slightly less, but 4170s. Let's see. I'm not clear on what the relationship is here. Does the CME reduce their bid-ask spreads whenever they've got an outsized market maker position? The spread is the market maker spread. Is it published anywhere which side they get outsized on? I don't know what that means. I completely understand the utility of a short put given the short ES futures position, but the 0 data volume on a different contract confuses me. Well, so let's say that I witness a whole bunch of people rushing the beer store and buying up a whole bunch of beer. Across the street in Canada, we have stores called the beer store. You must go to the beer store. Well, actually, some of it's in the grocery stores now, but let's say that there's a run on beer, and I'm looking at the run on beer and I'm saying they're going to run out. I can head down to the liquor store and corner the market on liquor store, because as soon as they run out of beer, they're going to run to the liquor store, right? So you don't have to actually try to get the same thing that everyone else is doing. You just have to look at activity going on somewhere, and you could go somewhere else. So the futures are going to move no matter what. So if you're dealing with 0 day to expiration options, and there are buyers of options, the market maker is selling, is on the other side. And if they're selling, they have to buy the underlying. They have to buy whatever the underlying happens to be. So as you're watching, you've got all your prices, all your strikes, and you have your options, and you have all the volume. Let's say that is where the market happens to be. So you can just sort of eyeball it and see where the volume is happening. And you can see the numbers tick up over here. You could say, well, there's a lot of put buying. That means there's got to be a lot of put selling. And if there's put selling, there's going to be selling of the underlying to hedge that. So it's just a matter of looking at where the volume is. And the volume, when you have days where the market sells off and you have this kind of thing and then you have this kind of thing, we've seen days like that where you end pretty much where you started, and you got all these sorts of things going on here. It kind of lines up with the volume, So if you see just a whole bunch of volume happening on the calls wherever the market happens to be, and they happen up here, but still they create deltas which have to be hedged, because you have a dealer that's selling, which means it must buy the underlying shares. So if you see a whole bunch of this starting to happen, so the market dips down and then you start seeing a whole bunch of activity here, it's not going to be long before the dealer has to buy, right? And up it goes, and the higher the market goes, you start seeing the volume shift over to here, where there's a whole bunch of put buying, while the dealer then has to start selling. So I'm just eyeballing it. There's no science behind it. It's just it's creating a lot of intraday volatility. So if it's creating intraday volatility, I'll trade that volatility. I don't have to trade 0-day to expiration options to do it. All the options will move with the underlying. I'll get the delta movement of the underlying no matter which one I'm using. So I use the 4170, and I've been using that for a while because it's very close to 50 delta. So why not get kind of like, right at 50? That's all. It's nothing that I could break out in charts with lines and graphs and 10 different indicators saying, aha, you see that? Like, it's nothing like that. It's just, I'm looking at where the volume is, and I'm seeing a lot more volume on one side of the screen than on the other side. Then I just say, well, I know what the dealer's got to do, so I'll do the same thing. Do you play short strangles on holdings going in earnings? No, I do not. No, I don't bother with that. That to me is just gambling. When I don't like to trade events ahead of time. I'll trade them after the fact. If something happens and I go, well, that's just an event, I'll trade that. But I don't like betting on the outcome of something. I know this depends on its price versus your valuation target, but if IV is high enough, you can get enough out of the money call premiums to make it worthwhile. Do you bother? Nah, not really. I mean, no, not really. I like certainty. I like to make more certain bets. I don't want to stand in front of a big event just because I'm making a bet on that event. And then cash out on that event. Well, that's a casino. I don't know that there's much value in there, because you got to be right. And you're either going to be right or wrong. I like to get in situations where if I'm right, I make money. If I'm wrong, I get something else of benefit for me. So, for example, today GM reported earnings, and in pre-market, they were up nice. They were up 3.5% in pre-market. They beat on earnings and they raised guidance. That's the best thing that you can have happen. But during the conference call, I guess there was some nervousness around their EV strategy. They did mention that it is ugly in China in terms of the price war, but they were looking to the end of the year that the second quarter was going to be challenging in China. They mentioned they're retiring the Bolt, the Chevy Bolt. But everyone sort of knew that was going to happen, but GM sold off. Well, that to me is an event. Now they already reported their earnings, and I saw that outcome, so I bought a hell of a lot more GM in the high 32s, low 33s. I was hoping for an opportunity. When I saw them bounce in the morning, I thought, it would be nice if they sold off on the opening just to recover. And they sold off on the opening but didn't recover. So I sold $35 puts and I bought shares at high 32s, low 33s. Now, if GM rallies above 35, great, I get all the money from the puts. If they don't, I end up buying GM at a lower price than I could have in the market that day. So if I wanted 10,000 shares, I could buy 5,000 shares at whatever price was going on. Let's say it was $33. You buy 5,000. You take the $35 puts, and I think they had like $2.55 in them, which means I was getting them for $32.45 if they're put to me. Why buy 10,000 at 33? Buy 5,000 at 33. Sell 50 puts at 35. You get them cheaper than the market has. If GM rallies above 35, I get to keep all of that premium. If it stays under 35, I actually get to buy the second 5,000 shares at 32.45 when GM was nowhere near there. See what I mean? Heads I win, tails I win. So I like to play outcomes where I kind of walk away with something to my benefit no matter what happens. Can you make a second part of my approach to portfolio management for retail investor? That starts August. If you have the applied series, it's about a 6-month seminar series where every week we're going to take one step further into portfolio construction and management. Can you elaborate on how you come with probabilities on Fed rate hikes for May and June? Fed Watch tool. Just go to the CME and look for the Fed, or go to Google and type in Fed Watch tool and just click on that link, or just look in the description box below this video and you'll see Fed Watch tool. Curious why you were bullish on the Canadian at this point given impending recession outlook. Consistent higher lows, hiking Fed versus paused Bank of Canada, bearish equity outlook. I assume it's because all the long-term bullish commodity story and immigration. I was just wondering. The Canadian has held up quite well overall. Our inflation CPI came in at 0.6. The expectation was 0.4, so it ticked up on the month-to-month basis. Tiff Macklem, that is his name, by the way, Tiff Macklem. I'm going to point it out every time I say it. Tiff said that he has not taken another interest rate hike off the table. It is possible. Oil prices are elevated. Canada has been talking about its potential for rare earths metals, the supply for rare earths metals. So, there seem to be some positives behind the Canadian, and sometimes you just have to take the market for what it is. The Canadian has surprised me in its resiliency. We were on hold last Bank of Canada meeting, and the Canadian dollar just kept getting stronger. Which when you see empirically something going on that doesn't seem to match, what you have theoretically in your head, well, then you kind of have to trade it empirically. And because I'm Canadian, my worst case scenario is I end up with some Canadian dollars. Oof, what will I ever do with Canadian dollars in Canada, right? So my downside is I get Canadian dollars. My upside is, they could be worth more. Well, that's all. Also wondering your thoughts on market leadership, resetting in new bull markets. Does it have to be this way? It doesn't necessarily have to be this way. It is just an empirical regularity. It's an observation. If you look at all new cycles, leadership comes from a different place. It doesn't have to be that way. It just has been that way. And because it has been that way, there's this feeling that, well, we need to wait for that to happen again. But every time we have a rally, it's the same 6-7 stocks that rally, and Bitcoin rallies and crypto rallies. And it's like, well, look, we're right back to where we were. We're just revisiting the past cycle. We haven't really changed anything because everyone thinks we're still in the same economy. So it has just been an empirical observation. When we say empirical, it means we just look at the real world and this is what we see. I've been thinking Q should take a beat for a while. An Apple 10% off high seems unlike other bear markets were it to be ending. The Meldrum said the other day mega cap tech was valued fine at this point. So I was wondering your thoughts. If mega cap tech is valued fine, then why would they lead? I mean, if you came out with the argument that mega cap tech was ridiculously undervalued, then you could make the argument, yeah, they should lead. But if the saying is that they're valued fine, meaning they're fairly valued, why would you buy something that's fairly valued? You'd want something undervalued, right? So I don't know that that is an argument for why leadership has to come from those that are fairly valued. Regarding VIX, I don't think it's broken. It takes actual implied volatility from 23 to 37. I don't think 0-day increased vol can make up the lack of it on other expiration days. The increase in volume, almost all the increase in volume in options since last summer has been in 0-day to expiration. There has been no increase, when you account for those, no increase in option volume at all. And usually when you get to bear markets, option volume picks up, especially the put buying. Option volume does pick up. Well, option volume has picked up, but almost 100% of the pickup in volume has been in 0-day to expiration. So the regular fear is not showing up where it should. So it is having an effect, because implied volatility, the very first word, implied, it's implied. We can't observe it, but we can observe everything else. And it depends on the price of the option. And the price of the option, really, because of implied volatility, because you can't use an options pricing model, it's no arbitrage. Because if you say, well, based on the option pricing model, this call should be $3, this call is $2, it's underpriced. Yeah, but hang on a second. You had to use future volatility in your options pricing model. Maybe you're wrong. So the price is what it is because of supply and demand. So if there is no extra demand going on, even when markets are dropping, there's no extra demand, then it's not going to push prices up, which means implied volatility is not going to move. So it can have an effect, even though it's not measured, just by taking volume away from where it is measured. In your S&P section, you discussed your ads. Can you go over one of those underlying and why that particular strike? Go over one of those. Is it a top-down thesis or something you're looking to add long-term? I don't know what you're referring to in my ads when you say, can you go over one of them? Which one of them? I think the only ones I'm looking at selling puts on, which I did today, by the way, were the miners. I sold puts on Rio, BHP, FCX, and Alcoa, and Oxy. I sold puts on all of them today. So I'm not sure how to answer this question. I'm not sure how to answer it. In the last Q&A, you mentioned you hold several hundred, if not thousands, of options. When I say thousands of options, it doesn't make sense for me to do 3 puts or 10 puts. At my size, it doesn't make any sense. I would have way too many positions if I were only doing 5 or 10 options. So when I look at selling puts, my minimum is 50 to 100. That would be the minimum. There are times where I have 800-900 options on one underlying. So it's, if you have 10 or 15 underlyings, it's easy to get into the thousands, but it's not as if I have thousands of positions. It's not really worth it for me to sell 5 puts. It just wouldn't even move the needle, that if I'm going to do something, it has to be significant enough. I use MS Excel. But at my level, that's easily done. I can track my DDB. Well, I have the portfolio manager in IB that does all that for me. I can click on any line and it opens up with all the positions I have. I can see, let's say GM, it'll tell me exactly what my GM position is in terms of my delta, in terms of my index, the beta that I have, the index dollars that I have, or the equivalent index dollars. I get all of that at the level of GM, and then I can go down into detail into, well, what is the underlying providing and what is each option providing. So let's say I look at May and June. Well, I have options for May and options for June. Well, they'll be in different lines. So I can look at May and see what May is providing. Then I can click on the plus sign and all the options for May show up, and I can see what each one is contributing as well. So IB does all of that for me. I do want to hire someone to help with this. What options do you think are available to me? Your broker does all of that for you in terms of tracking all that stuff and provides you your tax forms at the end of the year. Those are non-editable tax forms. You don't get to send them in saying, oh, by the way, the entry in box 43 should be this number and the entry in box 35 should be that number. They're non-editable. They are reportable as they're given to you, and that's it. So I've never felt the need to work with spreadsheets that have thousands and thousands of lines. IB does it all for me. Let's see. With the CAD being your domestic currency, I'm just trying to understand the mechanics of your long CAD play. Do you short the US CAD pair? Sometimes. Or convert your US cash back to CAD? No, I don't bother with that. Sometimes I'll use the options. So today I sold puts on the June contract. I sold the at the 74-cent puts. They were 97 basis points. So I sold those. And if it's put to me, well, that's fine. It would be put to me at what, 73.03, which is the same as shorting it at like 136, 137, almost 137. Yeah, about 137. And sometimes I just use futures. I trade the options on ES aggressively. So US dollars build up in my account. So I can be in a fully hedged position, and in a month later, I've got US dollars I've got to hedge out. So if the Canadian is strong, I'd rather overhedge. When I think the Canadian is going to weaken, I underhedge. So when the Canadian starts, the pair goes 136, 135, 134, 133, that's when you sort of underhedge. And then when it gets, 135, 136, you start to equal hedge and then overhedge. And that's where I am right now. It's 136, almost got to 136.50. I had another short I was going to put on at 136.50 on the pair, and it never hit that number. Hats off, your Tesla prediction. With regards to the debt ceiling event, what would be the immediate effects on yields, if in your mind, if increased with delay, or if not increased, or increased sooner than expected? What is increasing? Okay, the ceiling. Do you see any chance that we see a new peak in the 10-year yield? A debt ceiling, I think, is negative for the economy if we think about it in terms of aggregate demand, because that's it. If you start shutting down parks and shutting down non-essential services, well, then nobody's getting any money. So nobody's spending that money. It could be enough that it causes a recession. If it causes a recession, well, then there's got to be accommodation by the central bank, which would mean a lowering of interest rates. So I don't know. I don't know, because it's never happened. I mean, yeah, there have been times where, there was brinkmanship and there was, okay, well, let's shut down this, let's shut down that. But, a couple of days of shutting things down, maybe a week or two of shutting things down, a deal always seems to happen. So the worst case scenario has never happened. And because you have no comparable, it's uncharted waters, which means there's heightened uncertainty. And when there's heightened uncertainty, well, then all sorts of things can happen, like CDS spreads widening, right? Anybody within the U.S. would say, well, even if there's a shutdown, even if they don't pass anything, it's all going to get paid at some point. It's all going to get paid. But in other markets, you can't discount how they get their news, right? If you think about watching North American news channels, your view about other parts of the world are seen through that lens. But when you watch, and there are lots on YouTube, you can watch a lot of news channels that are African-based, for example, and you'll get a very different opinion of what's going on that continent by watching news from that perspective and listen to how they report about America, because for them, America's way over there, and there's more uncertainty on their side. So the uncertainty that you're seeing showing up in the CDS spread could be just from outside of the U.S. doing that. But what would happen? I don't know. What's your arguments for active investing versus indexing, given the history showing most? Well, I think I've touched on that before. Most active managers don't outperform the index when the index is their benchmark. It means their hands are tied, because usually if that's their benchmark, then there's limitations on what they can do. They can't just go free rein. If you can, I would seem to think hedge funds as a group probably outperform active managers with a benchmark as a group, because they don't have a benchmark. I think that benchmark agnostic funds probably outperform benchmark aware funds as a group. Now, I haven't seen any research on that, but it seems to me that would be a logical conclusion to reach. Following a class for structured products, do you use the exotic option? Not really. Plain vanilla. Or do you know where they are in IB? Well, exotic is not a type, it's a description of something. It's like saying I drive red cars. Do you know where the red cars would be? Well, they're all over the place. I mean, it's, so it's not as if there is a car that is red. It's lots of cars. Some happen to be red, right? There are lots of options. Some happen to be labeled exotic options. I see that you keep loading up on TLT, but if you think that the forward curve will flatten, wouldn't that bring the longer end of the curve to some extent? No, that's not what I was saying. If you think about a decision tree, right? Here we are. Fed is going to cut. TLT. Fed is not going to cut. Then that forward curve is going to have to start doing this. And if that forward curve does this, the cost of capital goes higher. If the cost of capital goes higher, then the market is priced too high. And if the cost of capital is higher, well, that is usually the beginning, or at least part of the beginning of companies rationalizing, laying off workers, cutting costs. And at some point, you're going to cause a recession. Fed is going to cut. So when I say that this forward curve has to come up, that's not a positive thing. That's also a negative thing. The equity markets just haven't got that right. They have not adjusted the cost of capital yet. So if the cost of capital gets higher, well, then the only way to justify being in equities is if you're getting a lower price, because the cost of equity is, at the very first, a function of the cost of treasuries, of whatever they happen to be, the risk-free rate. So I'm long TLT. I have duration on TLT for the simple reason that if a recession shows up and something is really bad, you're not going to get a chance to get into duration by the time you wake up in the morning. It's simply just going to happen. So there I sit. And it's got a yield. I'm comfortable with the yield. And I do think the negative correlation between beta and duration is going to show up. And I'm short beta. So I'm short beta, so why not be long duration? Duration pays me. And I'm short beta, so that means that I have positive roll over here. All right, and since I'm using the options on TLT, I don't have to worry about any negative roll. I have negative theta because I'm long options, but I've already managed my option position such that if TLT doesn't go over 110, I make money. If it goes over 110, I make even more money. So that no matter what happens at this point, I'm going to make money on TLT. In your tactical trade of short calls on S&P 500, how would you manage a scenario of you out of the trade if the price keeps falling? Well, I'm short futures anyways, and I've sold a whole bunch of calls at 4,000 for June expiration with the September underlying. I've sold a whole bunch of 4,000 calls, of which I'm underwater on. So selling 4170 puts, and I think my average on the 4,000 calls is 176, which means my break even is 4176. And when I sell the 4170s, I'm looking to get as close to 100 as I can, 95 to 100. I got some today at 122. I was very happy about that. I sold some puts on the 170 at 122. But I got a whole bunch of short puts on 4170 sitting very close to 100. Which makes my break even 4076. So look at the difference here. 4070. So look at the difference between here. That's all profit in between there. So worst case scenario, I'm okay. Now if it keeps dropping and dropping and dropping, well then I get all of the premium from the 4,000 calls that I sold, and I'm already short more ES than I've sold options on. So I'm good there as well. I would be minimizing my gain, or not minimizing my gain, or I would not be maximizing my gain if it continued to drop. I just don't see the catalyst for sub 3,800 yet, or 3,700 or 3,600. It doesn't feel like it's there yet. It doesn't feel like the market wants 4,200. It's tried a couple of times over the last 3-4 weeks. Not a couple of times. It's tried quite a few times, and there just doesn't seem to be a lot of excitement in getting to 4,200 on the index. Not the futures, but on the index. It just doesn't seem, you get to 4,150, 4,160, it seems to sputter and fail. Well, the market doesn't like anything going sideways. If it's not going up, it must be going down, and it went down today. So I was referring your website to a friend who asked, what is your role in the company? I provide content. Short ES position, given the double negative carry with short call options. Yeah, that's beautiful. Is there an argument for using these exclusively, taking the actual short futures position only if it's assigned? No, I don't mind the futures. The futures have a delta of 1. To create the same delta, you got to be short two calls. All right, so I don't mind it. Plus, when you have the underlying, it allows you to sell puts against it if you have intraday volatility that you want to take advantage of. And if you're wrong, oh well, now you're hedged, right? So, tails, I'm hedged. Heads, I make money. No downside. So it allows you to be more flexible in your strategy. You've also discussed staying tactical as there are ebbs and flows in SPX. How do you determine your bands and where you'd start adding to the position, where you'd start to close? Every day is different. Some days seem to have intraday volatility in like a 20 or 30 point range. Other days in like a 7 or 8 point range, or even a 10 point range where you're up 6 or 7 points and you're down 5 or 6 points and you're up 6 or 7 points. There's nothing to be done in those narrow ranges. Those are absolutely boring days because just nothing going on. I need 20, 30 point ranges to make things happen. And you get the feel of it. You get the feel of it rather early. Once the market opens, you can sort of get a feel for it. If how it's moving in the day. It's just experience and intuition. Let's see. Are you also observing for big moves anchored to an open close peak trough? I don't know that I'm doing anything like that. I don't know what you mean when you say those words, so I don't know, what you mean there, so I can't answer that. What would a true soft landing feature besides low growth and higher multiples? Is it even possible? Yeah, it is possible. The outcome of a soft landing at this point in time would be a higher neutral rate, 5%. So if we think we're getting a soft landing, then the neutral rate's 5%. That's it. So, which means you have to price in a permanently higher cost of capital, which means the equity markets are valued too high. Hard landing, equity markets are valued too high. Soft landing in the economy, sure, equity markets are valued too high, because the neutral rate means it is the rate at which inflation is not accelerating and the economy is not breaking down. Okay, well then there you go. 5% is neutral. Why, if you have both your mandates checked and you're at the neutral rate, why change rates? The market has not priced in a permanently higher cost of capital at this point in time. So yeah, you could have a soft landing, but that's not a good outcome. Yeah, you could have a hard landing. I think that's a better outcome because you will get a lower cost of capital. You'll wipe out a whole bunch of zombie companies and inefficient companies and inefficient allocations of capital that don't exist. You'll create a whole bunch of spare capacity in the economy such that you can have a bull run without having to worry that inflation's just going to show up because we're trying to go into an above trend growth expansion with unemployment at 3.5% and thinking somehow magically that's not going to cause any kind of wage inflation, right? Best way to play a credit spread increase on private companies. Don't think you can. They're private by the very nature. There is no publicly traded security. You alluded to this in a previous video, but could you explain once more why you are day trading SPY puts? Why not? I know it relates to zero data expiration, but I don't remember the whole rationale. Well, the zero data expiration options creates lots of intraday volatility, but not lots of volatility from day to day. If you look at closing prices, there's not a lot of volatility day to day, but there's a lot of intraday volatility. Well, if you want a paycheck, that's what you're going to do. You're going to go where volatility happens to be. It's intraday. I know how to day trade. I don't enjoy it. I don't want to spend my day doing that kind of thing because you probably get 3 or 4 good trades in the day. At least the way I do it, 3 to 4 good ones. But you need patience, and it's bloody boring. It's just bloody boring to do, but I can do it. And if that's where the volatility is, and I feel like, making a paycheck today, then that's what I'll do. I want to have enough capital in my brokerage account to be able to generate enough options premium to replace my working income. This would allow me to temporarily leave the workforce and focus on studying CFA. I realize it's a very broad question to ask given the many option strategies and seemingly infinite number of variables in the market, but how would you personally gauge whether you're not sufficient amount of capital? Take your, if you're going to do this kind of trading, you could probably be a little bit more aggressive than 0.1%, but take your capital and multiply it by 0.00, let's say 0.004. Yeah, that probably sounds decent enough. And that's how much you could target per day. So if you have $1,000, $4 per day. If you have $10,000, you should be able to target $40 per day. And if you have $100,000, you should be able to target $400 per day. You may think, well, $40 a day isn't very much, but you have to multiply that by the amount of days in a year, and keep in mind you only have $10,000 in capital. Now figure out what that kind of return is, right? That's not, that's it's not too aggressive, but it's not conservative. It's if you know what you're doing, you can bring it to that level. So take how much money you have, multiply by 0.004, and if you're good, that is what you can generate per day, equals, X, whatever X happens to be. Let's see. Seeing a lot of people point to commitment of traders data and how hedge funds are positioned. If many are positioned short, can these positions have an effect on the actual market if shorts are forced to cover? My thinking is that it won't, because futures don't have any price effect on the underlying. Well, there is an arbitrage relationship between the futures and the underlying, that if you have a lot of demand in the futures that starts to push the price, there will be arbitrage that shorts the futures and buys the underlying. So it can have an effect on the underlying. Do you find any value in COT data? The value that I find in COT data is not that it gives me some indication of where the market's going to go, but it talks to me about sentiment. And this idea that, well, if everyone's bearish, you should be bullish. Well, what if everyone's bearish and that's the right thing to be, right? I mean, if there's a lion walking around your neighborhood and everyone's in their house terrified, does that mean you should be brave all of a sudden? Say, well, if everyone's inside terrified, that means there must be no lion. I'll go outside. Well, what if there is one, right? I've never really bought into that too much. Well, what if everyone is bearish for a bloody good reason? The idea that, no one's going in the water because everyone's afraid of a shark, that means I could go in the water because there's no shark now. Just because everyone's afraid of it means it doesn't exist. I don't buy into that. Maybe the argument being, well, if everyone is doing that, it wouldn't take much to force a short covering. Somebody to come in and force a short covering, and play that game. So it really just tells me about sentiment, and that's about it. I don't know that I get a lot of value out of it. So I would say this, though. If you get to extreme positions of bullishness or bearishness, there's where you have to be a little bit wary, because some other player is going to say, that is, there are way too many people in the room. I'm going to burn it down, and everyone's going to have to run for the exits. So, they may position themselves opposite and then really start to force the price, which then starts a cascading of the weakest hands folding first, and then that can create a short covering wave. But you got to be a larger player to do it. So I would say that maybe when you see an oversized a sentiment, or overweight sentiment somewhere, maybe the market is right, maybe everyone's right, but you should be wary that, well, that might be ripe for a short squeeze, right? Can you show us where to observe zero-day option volume on IBKR? Just in options chain, you click on the tab that says 0 days, which is today, and you have your volume open, and you just look at the volume. That's it. What are your thoughts on preferreds at this time? It depends on what kind of preferreds. But preferreds are just a great way to get bond-like income with a dividend tax rate, right? I'm buying treasuries in IBKR to get a bit of yield while holding cash. I'm from Switzerland. I've been seeing strong USD devaluation against the Swiss. Yeah, that's under 90 now, right? Is there a way to hedge a currency? Okay, I've already answered that. What topics will you cover and add to the applied series in the upcoming month? If you go to the markmeldrum.com, go to the website, click on applied series, and select one. I think once you click on applied series, you get the pricing grid up. You'll see a PDF that you can download, and once you download the PDF, it goes through each of the sections and tells you what is coming this fall. If you have thoughts on how increased bank regulation and focus on duration will impact demand for MBS and impact to MREITs for wider, I'm not even thinking about 4 or 5 moves ahead like that. No, I've given it no thought. That's the shortest answer. As a Canadian, can you comment how you allocate between taxable TFSA, RSP, Canadian REITs, and TFSA, pretty much. Although I'm out of all my REITs altogether, I don't have any REITs left anymore. American, but yeah, that is the way. That's exactly how I would do it. In my RSP, what I have right now is mortgage REITs, U.S. mortgage REITs, and GM. Some GM in my RSP. In my TFSA, I have preferred shares. That's all I'm holding. All through one ETF, ZPR. It's all in one ETF. Does the index account for seasonality? Well, I think that can be looked up. I think you could just Google that and ask if they have a site. They have frequently asked questions. I think you can look that up. Lisa Cook's speech about economy suggested that the past week CPI showed sign of slowing in housing services, inflation, owner's equivalent rent helped by supply of multifamily housing. Can we consider rent on new leases as a leading indicator? Well, it isn't a leading indicator to forecast any movement on housing prices. I imagine you could, but housing prices in Canada in March ticked up, and we saw today with Case Shiller that housing prices in the U.S. were higher than expected for the month of February. So, I don't know too much what the correlation between, a rental index versus a housing index would be. Can you comment on why home builders are showing huge outperformance? I've said it again and again. I've been saying it for quite some time. Lack of supply. If you want to create a great market for the suppliers of a product, create a lack of supply with more demand than supply, and it is a seller's market. And that's exactly what's going on in the sector right now, is just a general lack of supply. Do you have a price target level for TLT? Nope, I do not. Because it's bond related. And to have a price target, I would have to have a yield target. And I don't have a yield target. Any reason why do you prefer GM and Ford versus buying an automaker ETF? I don't know. Never occurred to me to buy an automaker ETF. I don't know. I haven't given that any thought at all. I have no answer for that. Where can we get information about Treasury tax day and balance? From the Treasury. Any thoughts on renaming this the Market Outlook? That's funny. Debt ceiling fight has introduced an added element of uncertainty in the TLT trade. Study by Brookings Institute in 2013 conclude the consequences of suspended social obligations. Not even interest or principal payment of Treasury would be a severe disruption to equity markets and a raised borrowing costs on the 10-year by 80 basis points. I cannot foresee that scenario would not bring about a recession, but it's difficult to judge whether the long bond market would not react by a jump in the borrowing costs before falling back to an affirmed. I don't know if that's a question. It sounds more like a statement. I don't know what the question is here. Where can we look at government CDS spreads? You're going to need some kind of subscription to get that. That's very specific data. It's OTC. For the most part, as a retail investor, you're not even allowed to participate in that market, so it's not of any value to you. Kathy Wood theme, I get the impression she's only interested in her management fee. It could be. When assessing how your performance forecasts at Tesla stack up against actual, wouldn't you want to use an adjusted income statement? I did compare it against the non-GAAP income, not the GAAP income. How will you do the August seminar in Classic? I often hear a Bloomberg narrative that this is the most forecasted recession in history. Most expected, I don't know about forecasted, most expected. Seems like nonsense to me because big directional moves require common sentiment. So who's on the other side of our ES trade right now? The dealer. The dealer's on the other side of everything because they hedge everything out. It couldn't possibly only be hedgies and useful idiot retail bulls. No. Is this a structural feature of large long-only funds that must be fully invested? If they were long-only, most long-only don't really use derivatives to that extent. They'd be long. The underlying. Is the certainty over a coming recession making the way out of it less uncertain? Is the certainty over a coming recession making the way out of it less uncertain? Okay, that's a riddle, and I don't know what that means. This whole narrative seems to ignore the opportunity to sell high and buy back low. I'm lost. I'm lost now. I don't know what that means either. I'm gonna keep going here. I don't know what that means. I don't want to be an ABR because of office real estate. 98% of their loans are multifamily, single-family, residential. So, don't know about that. I will just trade it Cosenza style. Yeah, well, exactly. Let's see. Has your knowledge and hard work trading been worth it when compared with a simple buy and hold? Oh, yes. Oh, yes. I'm curious, just because in my case, would it have been better to do the latter? To do the latter to what? Just hold the SPY year to date 8.2? The latter means the second part, the active part, so I'm not sure where you're going there. You have said use SOFR, can't use 1 month treasury anymore. No, not really. 1 month is got some non-price sensitive buyers in there. It's not a signal. How do you see store closing affecting the economy? I don't. If there are 24 clothing stores and 5 of them disappear, there are 17 clothing stores that'll just do more business. That's all. There's just too many. There are too many retail stores. Bed Bath & Beyond disappears. It doesn't mean that a whole bunch of money will now not be spent in the economy. It just means that another place that sells the same stuff they were selling will now get the money. I saw Target and Walmart reporting store closures around USA because of theft. Well, don't know that will hurt the economy. Let's see. Our price is going to increase for 2024 subscriptions. I don't know the answer to that. Will First Republic fall? Well, it did today. Oh boy, did it fall today. What are your thoughts on Warren Buffett and Charlie Munger speaking out against diversification? Well, I agree. You don't need to diversify. Hold a well-diversified portfolio like the SPY, such that all your idiosyncratic risk is diversified away. That is exactly their point. Is all the idiosyncratic risk is diversified away, and so they have concentrated positions in companies they want to own that meet their criteria. I agree with that. Where is Japan's inflation? It's there, but Japan has a demographic issue. So given their demographics and given the inflation they have, that is pretty good inflation, considering how old Japan is, on an average basis. Over the last 12 years, Japan has printed its way from 80 to 130 during one of the most expansionary monetary policy regimes in U.S. history. Well, let's be fair. It should never have been at 80. It should never have been at 80 to begin with. So that was way too strong given the economy that it had. The entire time, BOG rates have sat at or below zero. And yet Japan has spent more time in deflationary environment. It's because of their demographics, right? I know UIRP need not hold, but this seems a little absurd. The only conclusion I've been able to come up with is overly expansionary fiscal policy in the form of government-subsidized price controls fueled by U.S. Okay, I don't know where you're going there. Fueled by U.S. debt. I don't know where you're going there. All right, that is the end of that.